Picture Houston in the mid-1980s. The city hums with ambition. Skyscrapers glitter in the sun. Oil rigs and pipelines stretch for miles, carrying the lifeblood of the American economy. Amidst this industrial heartbeat, a company quietly begins to take shape. A company that would one day dominate headlines, dominate markets, and dominate the imagination of investors everywhere. This company is Enron. To most, it was just another energy firm. But for Kenneth Lay, it was more than that. Lay was a man who believed that ambition, charm, and strategic vision could reshape the world of energy forever. He didn't just want to run a company, he wanted to create a legend. Joining him was Jeffrey Skilling, a rising star with a mind wired for numbers and a vision for Wall Street-style financial innovation. Together, they would build something extraordinary and something dangerous.
In 1985, Houston Natural Gas merged with Internorth, forming a new entity that retained Kenneth Lay as its CEO. The merger seemed practical on paper, two energy companies combining resources, pipelines, and expertise. But Lay had bigger dreams. He wanted to transform the company into a trading powerhouse, something entirely new for the energy sector. Enter Skilling. Skilling had an almost mathematical fascination with markets. He saw opportunities in energy trading that others ignored. Where most executives focused on pipelines and physical infrastructure, Skilling imagined a financial infrastructure, buying and selling energy contracts, not just the energy itself. To him, energy was a commodity that could be manipulated, leveraged, and traded on paper to generate wealth almost out of thin air. Together, Lay and Skilling cultivated a culture of optimism and ambition. Employees were told to innovate, take risks, and think big. The mantra of Enron became a beacon for Wall Street's imagination. Bold ideas rewarded, innovation celebrated, skepticism discouraged. But this culture, as intoxicating as it was, planted the seeds for one of the greatest corporate deceptions in history. The brilliance of Enron would also become its downfall.
By the 1990s, Enron had transformed into a Wall Street darling. The company expanded aggressively. Natural gas, electricity, broadband internet. If it could be traded, Enron wanted it. To investors, it appeared unstoppable. Stock prices soared from single digits to nearly $90 per share in less than a decade. Fortune magazine lauded Enron as America's most innovative company. Executives were heroes, their offices emblems of success, and their wealth unimaginable. Employees were incentivized with stock options and performance bonuses. Everyone had a stake in the magic. Everyone believed the illusion. But behind the gleaming towers and glossy reports, the company's financial house had cracks. Special purpose entities, or SPEs, were quietly used to hide debt. Profits were inflated. Losses were shunted off the balance sheet into shell companies, invisible to investors. For Wall Street, it was a dream come true. For Enron insiders, it was a carefully orchestrated illusion. And for the unsuspecting public, it was the calm before a storm that would change corporate America forever.
Enron's brilliance lay not in its energy infrastructure, but in its mastery of financial engineering. Skilling's derivative strategy allowed Enron to trade future energy contracts in a way that few outside the company could understand. The mechanics were complex. Energy could be bought, sold, bundled, and resold, sometimes multiple times, on paper alone. Profits were recorded before actual revenue existed. SPEs were created to move liabilities off the balance sheet. The company appeared far healthier and more profitable than it really was. It was genius, and it was dangerous. Executives were rewarded for growth, not sustainability. The culture encouraged aggressive accounting, risk-taking, and silence. If a manager questioned a strategy, they were labeled as unambitious or untrustworthy. Ambition became currency, secrecy became law, and deception became...
By the late 1990s, Enron's financial statements were masterpieces of illusion. The company's brilliance lay not in pipelines or power plants, but in numbers that danced, disappeared and reappeared in ways no one outside the company could follow. The tool of choice? Special Purpose Entities, or SPEs. On the surface, these were simple partnerships created to manage risk, but in practice, they were shells, phantom companies designed to hide billions in debt to make Enron appear more profitable than it truly was. Jeffrey Skilling and CFO Andrew Fastow orchestrated these entities like puppet masters, moving assets and liabilities back and forth in a dizzying game. A loss on the books could be transferred to an SPE, erased from Enron's balance sheet, while profits were recorded almost magically on paper. The illusion was flawless, at least to the untrained eye. This was not merely accounting, it was financial sorcery. Wall Street analysts, mesmerized by Enron's growth and confident leadership, rarely questioned the details. The company had created a narrative of innovation, a story so compelling that no one wanted to see the cracks. And yet, the cracks were there. They were waiting, and the consequences would be catastrophic. One of Enron's most powerful tools was mark-to-market accounting. The principle was simple in theory: record the present value of future contracts as revenue today. In practice, it was a license to lie. Imagine selling a 20-year energy contract. Instead of reporting revenue as it came in over the decades, Enron booked the total projected profit immediately. If the future didn't match the projection, no matter. The numbers on paper looked impressive. This method allowed Enron to inflate earnings, attract investors, and justify enormous executive bonuses. The company appeared unstoppable. The stock soared, and executives, including Skilling and Lay, cashed in millions. It was a financial illusion, carefully designed, meticulously executed, and deadly effective. Enron's culture amplified the deception. Employees were indoctrinated with messages of ambition, risk, and innovation. Skepticism was dangerous. Questioning the numbers, questioning management, or questioning the strategy could end a career. Promotions were tied not to honesty, but to the ability to sell the illusion. The more an employee could push profits, the higher their reward. The system encouraged bending the truth and eventually breaking it entirely. Even those who saw anomalies often stayed silent, either out of fear or greed. The company became a machine where deception was rewarded, honesty was punished, and ambition blinded the brightest minds. Not everyone was fooled. Deep inside the company, a few brave employees began to notice irregularities. Accounts didn't add up. SPEs were shrouded in secrecy. Profits were too good to be true. Some tried to raise concerns, some went to auditors, others confided in friends. But in a culture that punished doubt, even the brave felt powerless. These whistleblowers would later play a crucial role in exposing the fraud, but at the time they were whispers against a storm, voices drowned out by ambition and charisma. The house of cards continued to rise, higher and higher, until the collapse was inevitable. Meanwhile, the world watched and applauded. Wall Street analysts, dazzled by growth and innovation, issued glowing reports. Journalists wrote stories celebrating Enron's brilliance. Investors poured money into the stock, confident in the company's unstoppable rise. Few questioned the complex SPEs, the aggressive accounting, or the unrealistic profit projections. The public trusted what was presented, a story of American ingenuity, corporate brilliance, and limitless opportunity. The deception was perfect because it was hidden in plain sight. But illusions, no matter how perfect, eventually meet reality. In 2001, cracks began to appear. Analysts questioned the opaque financial reports. The SPEs that had hidden debt started to unravel. Enron executives, however, reassured everyone. Everything is fine, they said. Trust the numbers, trust the plan. But behind the scenes, the empire was crumbling. Losses that had been hidden for years were starting to surface, threatening the company's image and stock price. The tension was palpable. Employees whispered in hallways. Traders sensed the instability.
Yet the company continued to project confidence, as if the facade alone could hold back reality.
By mid-2001, the cracks in Enron's empire were no longer small fissures, they were gaping chasms. Analysts began asking questions about the company's financial reports. SPEs that had hidden billions in debt were starting to leak. Employees whispered anxiously in hallways. Traders sensed volatility. Investors began to notice inconsistencies. But Enron's executives continued to project an air of calm confidence. Everything is on track, they assured the public. We are strong, growing, unstoppable. The illusion remained intact for a little while longer.
In August 2001, Enron announced a staggering $618 million loss stemming from its partnerships with SPEs. To outsiders, the news was shocking. How could the company that had been America's most innovative appear to falter? Yet, the worst was still to come. The loss was just the tip of the iceberg. Beneath the surface, the company's debt was far greater than anyone had imagined. The complex web of shell companies, insider deals, and off-balance sheet accounting had created a financial time bomb, and it was ticking loudly.
September 2001. The stock that had soared to nearly $90 per share was now dropping precipitously. Investors panicked. Retirement funds, college savings, and life savings vanished in hours. Employees who had been encouraged to invest in company stock were suddenly facing financial ruin. The same company that promised limitless opportunity had become a source of despair and confusion. Wall Street's faith was shaken. Analysts scrambled to explain the unexplainable. Media outlets covered the unraveling drama as if it were a Hollywood thriller, and in many ways it was.
Inside Enron, executives were acting decisively, though not in ways the public expected. Skilling, Lay, and other insiders were selling shares, often at peak prices, securing personal fortunes even as the company's foundation crumbled beneath them. To employees and investors, this seemed unimaginable, but within the corridors of power, it was calculated. While employees panicked and stockholders suffered, executives had already positioned themselves to escape the fallout. The betrayal was not just financial, it was personal. Trust, once absolute, had been shattered. As Enron's losses became public, the media descended. Headlines screamed of billions lost, executives enriched, and the company's implosion. Wall Street's darling had fallen. Analysts were mocked. Investors were outraged. Television footage showed employees leaving the office with boxes of belongings. Trading floors were chaotic, phones ringing endlessly, numbers flashing red on screens. The story became a national obsession, a real-life thriller exposing corporate deception at its most extreme. But the human cost was staggering. Thousands of employees lost their jobs. Many had invested their retirement savings in Enron stock, trusting the company they had built their lives around. Families faced financial ruin overnight. Dreams of security and prosperity vanished like smoke. The betrayal went beyond money. Loyalty, ambition, and hard work, values the company had preached, now seemed meaningless. The very culture that had fueled innovation had also amplified suffering. The stock market responded in kind. Enron's stock plummeted from $90 to under $1 within a year. Investors were left questioning not just Enron, but the entire system. How had one company, so lauded, so trusted, deceived so many for so long? Wall Street's confidence had been shaken to the core. The lessons were bitter and the costs immense. This was more than a corporate collapse. It was a cautionary tale for the ages. The collapse sparked outrage. Lawmakers demanded answers. Federal investigators launched probes into Enron's accounting practices, insider trading, and executive decisions. Public hearings became spectacles. Executives were grilled before Congress. Journalists uncovered the depth of the deception. Every revelation fueled public anger and disbelief. The scandal had become a symbol of corporate greed run unchecked.
The collapse of Enron was not just a story of financial mismanagement, it was a story of human ambition, deception, and the consequences of unchecked power. Wall Street had been fooled, employees had been betrayed, investors had been ruined. And yet, in the ashes of scandal, lessons emerged. Lessons about skepticism, oversight, and the dangers of blindly trusting charisma over substance. Enron's story would serve as a warning for decades to come.
The story of Enron's collapse was no longer a financial lesson, it had become a criminal case. As federal investigations intensified, the world learned just how deep the deception ran. Kenneth Lay, the company's revered founder, had long been the face of trust and integrity, yet the investigations revealed a man complicit in hiding debt, manipulating financial statements, and misleading investors. Jeffrey Skilling, the brilliant strategist who had crafted Enron's rise, was charged with multiple counts of fraud and insider trading. Andrew Fastow, the chief financial officer behind the SPEs, quickly became the poster child for corporate greed. His intricate web of partnerships and off-balance sheet schemes had allowed executives to siphon wealth while hiding the company's true financial state. The courts became the stage where Enron's secrets were finally laid bare. Lay, Skilling, and Fastow faced intense scrutiny. Every document, every email, every financial report was examined under a microscope. The public watched as the charade unraveled. The scandal did not stop with Enron alone. Arthur Andersen, one of the largest accounting firms in the world, had served as Enron's auditor. Their role was to verify the company's finances, but instead they became complicit in the deception. Documents were shredded, records destroyed, red flags ignored, and when federal investigators began to close in, Andersen's credibility was shattered. The firm, once a symbol of trust in corporate America, collapsed almost overnight. Thousands of employees lost their jobs. Entire careers were obliterated, not because they were dishonest, but because the company's reputation could not survive association with Enron's fraud. The legal consequences were monumental. Jeffrey Skilling was convicted on multiple counts of fraud, insider trading, and conspiracy. His sentences added up to decades behind bars. Kenneth Lay, meanwhile, was found guilty, but he died of a heart attack before sentencing could be carried out. Fastow, who cooperated with prosecutors, received a reduced sentence in exchange for testimony that helped unravel the intricate web of deceit. The trials were broadcast and reported endlessly. Americans were riveted. The story of corporate betrayal had become a national obsession. For those who had invested their life savings, watched their careers collapse, or simply admired Enron from afar, justice was complicated. Some executives were punished, some went free, and the full financial damage, billions lost, was irreversible.
Enron's collapse exposed weaknesses not only in corporate governance, but also in government oversight. Regulators realized that the existing framework was inadequate to detect or prevent such deception. In response, Congress passed the Sarbanes-Oxley Act of 2002. The legislation aimed to tighten corporate accounting, enforce stricter financial disclosure, and hold executives accountable for fraud. It was a direct response to the Enron scandal, a legal shield meant to prevent another disaster of this magnitude. While the law could not undo the losses of investors and employees, it changed corporate America forever. Boardrooms became more transparent, accounting firms faced higher scrutiny, and Wall Street, once dazzled by ambitious narratives, began to question numbers more rigorously.
The public was outraged. Media outlets dissected the scandal daily, highlighting the human cost, the executive greed, and the systemic failures that allowed Enron to thrive while deceiving everyone. Employees who had once proudly displayed Enron's logo now spoke of betrayal, despair, and shattered dreams. Investors who had believed in the promise of American ingenuity felt foolish, angry, and powerless.
Enron had not just collapsed financially, it had shaken the public's faith in corporations, auditors, and regulators. The scandal became a symbol of the dangers of unchecked ambition and unchecked trust.
So, what can we learn from Enron? First, ambition without ethics is a dangerous force. Enron's culture rewarded innovation, but it also rewarded secrecy, deception, and unchecked risk. Second, appearances can be deceiving. Wall Street and investors were dazzled by stock growth and charismatic leadership, ignoring warning signs and anomalies in financial reports. Third, oversight is crucial. Regulators, auditors, and analysts failed to question the numbers critically. Only after catastrophe struck were the weaknesses exposed and corrected through reforms like Sarbanes-Oxley. And finally, there is a human cost. Employees, families, and investors suffered losses that went far beyond the numbers on a balance sheet. Enron's story is a reminder that corporate greed and deception are not abstract. They have real, devastating consequences for real people.
Enron's legacy is complex. On one hand, it represents innovation and ambition, the daring to dream bigger than anyone thought possible. On the other hand, it represents deception, greed, and the dangers of prioritizing profit over transparency. Wall Street learned a hard lesson. Not every success story is what it seems. Regulators learned a lesson in vigilance. Employees learned about trust and betrayal. And the public learned that even the brightest, most celebrated companies can hide the darkest secrets. Enron rose spectacularly, and it fell spectacularly. And though the company is gone, its story endures, etched into corporate history as a cautionary tale of ambition, deception, and the consequences of unchecked power.
The rise and fall of Enron was more than a scandal. It was a story about human nature. Greed, ambition, and the desire to impress can drive brilliant minds to deceive. The house of cards may stand for a time, dazzling all who look upon it, but eventually, reality catches up. For Wall Street, investors, and corporate America, Enron is a reminder. Always ask why. Always look deeper. Because sometimes the brightest shine hides the darkest secrets. And sometimes history remembers.